Let me start with the economy and a basic fact. The United States of America, right now, has the strongest, most durable economy in the world. Anyone claiming that America's economy is in decline is peddling fiction.
All right, we're watching the stock market. We're getting hammered again today. Back to that in a moment. Tell you the reasons why your 401k is heading south.
The market is open and it's not looking good.
The Dow is down. You see it more than 300 points in early trading. This comes as oil prices fall below $30 a barrel. Also, there is still a lot of anxiety over China's slowing market.
Now this Fox News alert, a rough start to the new year, not getting any better on Wall Street today as the Dow starts with another major sell-off. You can see there down 390 points, erasing yesterday's gains. The Dow getting hammered after another big drop in crude oil prices, which just hit a new 12-year low.
Chief strategist from Bell Point Asset Management, David Nelson, joins us by phone. David, thanks for being with us. So here we are once again watching the market. Some people would say this is just a blip and not to worry. Others might say, look, the problem is there have been a lot of blips here in 2016. It's only January, and this doesn't seem to bode well. What do you say?
The last rhetoric, that seems to ring true. We're getting a whole series of data points here that are just pretty troubling. I can't point to any one thing, as the sole catalyst for today's sell-off. We had a pretty nice bounce off of yesterday's open. That was pretty, that was really nice, but it was a technical in nature. Probably the bad news started last night with Intel. Disappointing numbers coming out of Intel, especially in some of the bright areas, some of their growth areas like data centers. And then you spill over to China, their data was weak. And now you're seeing oil, trade and start to live below $30 a barrel. And I know that feels good when you go up to the pump and you're filling up your gas tank and you're paying a lot less for it. But if you're living in one of those energy-producing states here in the United States, you're starting to feel the pain here. So there's a whole series of events that are kind of colliding, creating a perfect storm, at least for today's open.
Well, Houston has definitely been feeling that pain. David, we keep talking about if you're investing in the stock market, it's more about the long road and not a day-to-day basis. So, what are you telling investors as we are looking at the markets right now?
It's hard to have the long-term picture when you wake up in the morning and you're looking at a market like this, and then later in the day and you start to look at your 401k. First thing that you should do with your retirement assets, you got to be positioned correctly to weather a storm like this. If you're approaching retirement and you've got all your money in stocks, you're really doing something wrong here. You're causing some real damage. You need to rethink that. If you're 20 to 25 and you see something like this, it's just a blip in the road. You're going to just keep pouring money in the market. You need to have some kind of diversification, and those are big words, and it sounds good. Look, I feel the pain. We go through this each and every day, managing assets, and it has a bunker mentality right now. It feels like we're all in a foxhole, weathering this storm. We will come out of the other side of this, but we're still testing the bottom here, and we're just not there yet.
All right, welcome back, everybody. You are looking at that gas, it too slip-sliding on a percentage basis, close to 2%. Let's take a look at the other key energy component that you've heard probably a little bit more about, and that is oil. It is under $30 a barrel, and there's a brokerage firm that there has an estimate, even with today's 5% plus slide, it is going to get to $20 a barrel. Of course, there are a lot of factors at play here.
Hi, everyone. I'm Meg Oliver.
And I'm Elaine Quijano. We start with a sell-off on Wall Street. The Dow is down more than 370 points in early trading.
Let's get right to our Jill Wagner. She is on the floor of the New York Stock Exchange. Jill, what are traders telling you?
Well, good morning, Meg and Elaine. Yeah, U.S. markets continue their free fall, and this is ahead of the long holiday weekend. The Dow and the Nasdaq are both plunging in just the minutes after the open. Yesterday, there was a bit of a rebound, but China's Shanghai Composite fell again today. It's now in a bear market, which means it's down 20% from recent highs. And there's a lot of concern because Chinese regulators have taken some pretty drastic steps to try and stop the sell-off. And at this point, it looks like whatever they're doing is not working. And the other issue here is that we're talking about a Friday before long holiday weekend. As it is on any given normal Friday, there's usually a sell-off. A lot of traders don't want to hold their position for the long weekend because all the markets around the world will be open Monday, but not here in the U.S. So they do think, unfortunately, that it could get a lot worse. And right now, the Dow is down 400 points. We're below 16,000, and it does not look like that's going to be turning around anytime soon.
All right, we know you'll continue to follow it. Jill Wagner at the New York Stock Exchange for us. Thank you.
All right, we are looking at a major sell-off now going at the corner of Wall abroad. It had been big and well into triple digits all day, but it accelerated really within the last half hour as the S&P slid to a 15-month low. Very few places money can find a pocket to hide, but generally when investors get nervous, they either put it under their mattress or they buy things like Treasury notes and bonds. Rates on those securities have gone below what they were prior to the Fed's hike. So you find that 10-year note rates, to which a lot of mortgages are pegged, are now pretty low. For a while, they got under 2%. But that will translate again into mortgages in the roughly 3.5% neck of the woods. It's not exact, but it is a fairly reliable constant. We are also hearing from Josh Earnest, I think Josh Earnest, that the Treasury Department is closely monitoring these market movements. No doubt watching Fox Business as they are. So when they say they're closely monitoring things, what do? You're just like, that's a sell-off, all right. Chris Bedford is a Daily Caller News Foundation editor-in-chief. Chris, good to see you in the flesh.
Good to see you.
What do you make of what's going on? I mean, we were talking about this last night in the debate. We're off to a very stumbling start for the markets. And a lot of people, you don't want to get ahead of yourself, have this sort of 2008 feel, do you?
I do. I think that we've seen warnings from some of the major banks that we're going to go back into another depression. The stock market is starting to sell off. People are starting to panic, and no one's really quite sure what we can rely on in the next year at all.
You know what I was thinking, and I know you and I got into this before, that this has been a market that's been propelled by accommodative Fed, obscenely low interest rates. Some would say justified, fine. But it's been propped up on training wheels, too. And now they're taking the training wheels away. And markets worldwide don't like that.
Yeah, and economists have been warning for some time that if the government is they're able to push back some of this hurt, they're able to push it back, but they're not able to cure it. They're just treating some of these symptoms. And before it's not going to get better. It's not going to cure the problems. It's not going to cure the housing crisis, the Fannie Mae, Freddie Mac stuff. None of that has gone away. And it's starting to build back up with this pressure. And the economy could certainly be in a lot of trouble as soon as the Feds maybe start to take the hand off the wound.
You know, I was trying to get into the irony of that with the candidates last night, that wouldn't it be something that this president, who came in as a result of an economic market crisis, there are other factors, I'm not attributing it solely, the next president comes in under the same conditions?
Not only the economic crisis, but a couple new wars in the Middle East. It seems like when this president came in, he was hoping to bring about a change in the U.S. economy. He was going to leave it better. He was going to leave better employment. He was going to leave less war. We're fighting in Afghanistan. We're still taking casualties. We may be going back into Iraq and Syria.
All right, that's touching lows and out of them 514 points, down about 3.15%. From our highs, close to 14%, well into correction territory, right between what would be a correction and a bear market at 20% from our highs. That is a bear market signal. Jeff Flock on what is in large part contributing to this, and that is tumbling oil prices. Right, Jeff?
Yeah, oil remaining below 30, Neil, and I'll tell you, even the out month now, that's the February contract we're talking about. If you look at the intraday today, you see the blood today. Even the next month, which is up on the board here now, they've moved to the March contract. That is approaching below $30. We're at 30.14 right now, so bad all around. There was positive news today from Barclays energy analyst, who within the last hour and a half tweeted, and here's his tweet, crude oil may have priced in all global headwinds now, but it may post a reversal only in the medium term. That's Miswin Mahesh of Barclays. He's saying we may have bottomed, but we're not going to recover anytime soon. One of the reasons is Iran. Today, a meeting in Vienna of the atomic energy folks indicating that the sanctions are going to be lifted. You know, when you look at what Iran is sitting on, 10% of the world's oil reserves, 150 billion billion barrels. They peaked at 6 million barrels back before the revolution, but it could still be another 100 million barrels. There's nothing good to support prices right now. Yeah.
Jeff Locke, thank you very, very much. Richard Kovacevic joining me right now, the former Wells Fargo chairman and CEO. Wells Fargo, like all those other financial issues, under intense selling pressure. And when I ever see anything like that, Richard, and very good to have you, and Happy New Year.
Thank you.
I wonder about 2008. You can't help but draw the comparison. Financial issues took a disproportionate hit, and then the selling begot more selling. Do you ever worry about those type of historic anomalies?
No, I think the conditions in 2008 were unique. You had 20 financial institutions that are all gone now that originated securities that should never have been originated. You had rating agencies that misrated them. You had Fannie and Freddie buying this junk, which they should never have done. Only a government agency would buy this. None of those conditions exist today. What you have today, I think, is simply what happens when central banks interfere with markets. Bernanke and Yellen said they wanted to encourage people to go into risk assets. Well, that creates bubbles. And when you have QE1, QE2, QE3, and they're still buying long-term bonds, you get into bubbles. And the faster those bubbles break, the better. And so that's what's happening now. The bubbles are popping. It happened with high-yield bonds. It's now happening in the stock market, and that's good.
Breaking news now, your 401k taking a historic hit today. The Dow with another triple-digit dive, almost off 400 points. That's right at a 1,500-point loss for the year. Oil has plunged as well. Look at all the major indices that are there today. Everything is in the red, from Home Depot to Intel. Everything is down, and largely that's because of oil, of course. Oil at least leading the way. The Dow was down almost 1,600 points for 2016 earlier in the day. Over in the wall, you'll be able to see how the Dow's done so far this year. Right now down about 8%. The price of oil went below $30 today and kept going, the lowest level in more than a decade. And Adam Shapiro is working it all for us, and he is live in the Fox Business newsroom here in Midtown Manhattan. Wow, sinker.
It is a sinker. I mean, at one point today, we were down 537 points, Shep, and we're accelerating to the downside now. I mean, Dow's down 413 points. The last half hour of this hour, that's the last half hour of trading, we could very well accelerate again to the downside because of two things. One, no market trading on Monday, and investors do not want to be held over a three-day weekend in long positions, especially with oil still trading down below $30, as you said, and with China selling off. You could see a big sell-off in the last half hour of trading today.
Analysts say a lot of this is about oil prices.
They are correct. It's look, the fact is that oil is low for two reasons. You've got a China slowdown. They are not buying oil. They are the world's largest consumer of oil. And yet the world continues to produce oil at huge quantities, with Iran about to start selling oil. I mean, this weekend, we're going to free up the money for Iran, and they're going to start selling oil again. It's going to depress oil prices with no one to buy it because the global economy, as reflected with China, is sinking.
The United States of America, right now, has the strongest, most durable economy in the world. We're in the middle of the longest streak of private sector job creation in history.
The world's largest retailer has announced it will be shutting down nearly 270 stores. The majority of them are here at home. By that I mean in the United States. Executives say they'll close 269 stores by the end of the month, as well as all of the company's smaller format outlets called Walmart Express. Never heard of that? Well, don't bother. They're gone. This represents just a small fraction of Walmart's 11,000 stores worldwide. But closing? It's part of Walmart's plan to focus on super centers, neighborhood markets, e-commerce, and pickup services for shoppers. Pickup services. Nearly all of the stores are set to be closed in the United States are within 10 miles of another Walmart. So this appears to be an effort to consolidate resources. Dunno. The company says it's working to move staffers to other locations. Walmart employs nearly 1.5 million people in the United States. a number equal to the entire population of Hawaii.
What if there were outside factors here that have nothing to do with market averages and resistance and support levels and all that? What if it was China, Iran, North Korea, ISIS, an unstable world? Maybe that's why all the markets of the world are feeling the same thing.